The new tax bill is flying through Congress right now. The House Ways and Means Committee have already passed this bill. It is going to the full House next, then to the Senate, and they're hoping to have this done by the 4th of July on the president's desk to sign and put into law. This tax bill is huge. Reduction in individual rates, doubling of the standard deduction, qualified small business deduction of 23% being made permanent. There's so many details and incentives in this bill. It is good for taxpayers. Now I want to break down all the details in today's video so you know how to plan for the future and one of the biggest expenses you have in building wealth, which is taxes. I'm Matt Sorensen. Let's build wealth. All right, let's hit small business owners first. We've got a deduction of 23% being made permanent, and we've got bonus depreciation coming back at 100%. So I want to break down those two provisions here and how they help you. First, the qualified small business deduction. This is 199A. This is the deduction you get as a business owner off your total income. For example, let's say that you made 200 grand during the year. Right now, you get a 20% deduction on that, so you're only taxed as if you made $160,000. The problem is that deduction expires this year and goes to zero. There will be no deduction in 2026 and moving forward. So the bill right now is saying we need to not only extend this, but we are going to make it permanent. QSBS deduction is being made permanent in the tax code under this bill, and it is going to a 23% rate. The first draft of the bill a few days ago was 22%. I don't know why, but we got an extra percent here in the final draft that went through House Ways and Means Committee and was approved. So right now, let's say again, you make 200 grand as a small business owner, you get to take a 23% deduction on your income. That would be $46,000 there. So now you're only taxed as if you made $154,000. That is huge, a massive deduction and win for small business. Now this deduction came about because in the last tax reform, big corporations went from a 35% corporate tax rate to a 21% corporate tax rate, and that was made permanent. No need to extend it, no worry about it expiring. Well, small business kind of got the short end of the stick because we only got this 10-year window that is now going to expire, but the bill makes this deduction permanent and takes it up to 23%. Huge win for small business. All right, the next one, excellent for business owners, is bonus depreciation is back at 100% depreciation. This is a great incentive for businesses to invest, buy equipment, vehicles, things to expand and grow their business, and they get to take 100% deduction and write off for those new purchases. Right now, typically when you buy equipment or vehicles in your business, you have to expense it over time. In last tax reform, they gave us this bonus depreciation, which allowed for greater expensing, more deductions, reduced taxable income for business owners. That is back. Now, this is not permanent though. Under the bill right now, bonus depreciation will expire at the end of 2029. So this is 100% though, and it applies for qualifying property bought by the business. Think of equipment, vehicles, mostly the things people are using this for, and that is going to expire again at the end of 2029. But big news, it's back. We'll take it for 5 years. Another nice thing for small business owners, maybe some of you have a side hustle, is 1099 reporting requirements are adjusting, and this kind of reduces burden for sending out 1099s. The first thing is if you're a business owner, you're paying someone in the business that's a contractor, you have to issue them a 1099. Now that dollar amount threshold used to be $600. Under the new bill, that'll go up to $2,000. So you only need to issue 1099s to people, contractors, you've paid over $2,000 or more. That's a huge increase. It's going to reduce burden for having to issue 1099s to anyone you paid $600 or more for. Also, on the 1099 rules, merchants and people like payment apps have to issue what's called a 1099K to small business owners. However, the threshold is increasing, so you'll only receive these 1099Ks if you had more than 20,000 from that place and over 200 transactions. So you'll probably get less 1099Ks. You still need to report the income, but for any of you that are small business owners or a side hustle, you're not going to need to worry about all these 1099s. It's going to reduce the burden and the reporting requirements, making it easier on small business. And this one particularly, I think, is most helpful for those with a side hustle. All right, now let's talk about the provisions for individuals. There are a lot here, a lot of good wins, reduction of rates, credits, increase on deductions that you can take as an individual. And most of these benefit lower and middle income taxpayers. The higher rate stuff, there's some phase outs on here. There's also a new rule that limits the value of a deduction that's punitive punitive to higher income earners. So not to be political here, but I do want to note there are a couple bad things in the bill here for higher income earners. And I think this is Congress trying to get this through and have a more moderate type bill. But I think this is great for taxpayers because it is definitely going to benefit the middle class and working Americans. All right, let's jump into the bill here. The first thing is reduction of individual rates. Right now, the highest rate is 37%. That is set to go to 39% next year. If there's no new tax policy, it's increasing automatically because the Tax Cuts and Jobs Act, the reduction in rates is expiring in this 10-year window, again, up this year. This is going to be made permanent though. Okay, the lower rates that we currently have right now, which went down for everybody. 10 years ago, everybody's rate went down, high income, middle income, lower income, from between 2 to 3%. If this bill is not passed, everyone's automatically going to go up 2 to 3% no matter your tax bracket. So the lower rates are being made permanent. They're not extended for 10 years. They're being made permanent. That's a huge win. The highest bracket will be 37%. The next thing that is massive, the standard deduction is being doubled. Right now, you get a $29,000 deduction as a standard deduction as a married couple. Next year, that's going to go to like $16,000 if there's no tax policy passed. Now, the standard deduction is also being made permanent. So what this means, for example, if you make $100,000 and you're married filing joint, you get to take a $29,000 deduction. Your only tax is if you made $71,000. Next year, if this bill isn't passed, you make $100,000, you're only going to get a $16,000 deduction. You're going to be taxed if you made $84,000. That means you're going to owe more tax because you're going to have more taxable income. So the standard deduction is nice. Frankly, this is something that more middle income, lower income taxpayers use. High income individuals do the itemized deduction. They have more charitable contributions. They have mortgage interest and things that you itemize. They don't even use the standard deduction, so this doesn't even help them. So this is a big benefit, the doubling of the standard deduction. Next, the child tax credit. The child tax credit right now is $2,000 per child, and this is a tax credit. You get to take $2,000 off the money you owe to the IRS, but you get that tax credit per child right now, $2,000. Next year, though, under the new bill, the child tax credit's going up, in fact, to $2,500 per child. Now, what's happening under the new bill here is they're making permanent the $2,000 per child tax credit, and it's going to adjust upward for inflation. But for the next 3 years until 2028, it is going to be $2,500 per child. Okay, so it's kind of confusing there. There's a temporary $2,500, but then the $2,000 is being made permanent after that time period. And again, it will still go up and adjust for inflation. That is a massive win for families. Those having children, you're going to get a much larger tax credit. All right, now the next one for individuals is kind of unique. It's a deduction on any auto loan interest you pay to purchase a vehicle that is manufactured in the US, and this counts for the next 3 years through 2028. You can take up to $10,000 of a deduction, whether you itemize or not. You don't have to itemize. You can take the standard deduction. You can itemize. Either way, you can get this. This is an interesting one we haven't seen before, but it's meant to incentivize people to buy US made and manufactured automobiles. Now, there is some high income phase outs on this, $100,000 single, $200,000 married filing joint. You won't be able to use that deduction, but kind of an interesting one. You're probably going to see hundreds of thousands, millions of Americans use and take a deduction. Let's talk about some of the provisions Trump promised on the campaign trail. Taxes on tips and overtime. That will not be taxable starting in year 2025. So for this year's tax, tips and overtime are not taxable up until tax year 2028. This is not being made permanent. It will go away in 2028, but you're going to have 4 years of tax returns where you won't have to pay tax on your tips or overtime pay. There is high income phase outs on this. So if you're a high income earner, this isn't going to count, but most high income earners aren't getting tipped or they're on salary, so they're not getting overtime pay anyways. So I don't know that's too big of an issue, but again, there's going to be a deduction. No tax on tips for years 2025 through 2028. Now, one of the provisions that isn't specifically in the bill is no tax on Social Security. Trump and many Republicans promised that on the campaign trail. Now, what they have done though that can kind of be similar to this is there is a provision in the bill that increases the standard deduction for seniors specifically by $4,000 per tax year. This is again one that's going to go from tax year 2025 through 2028. So it's going to give a higher deduction for seniors that they get to take on their tax return. And I think this is the trade-off for no tax on Social Security that they're trying to offer up. This phases out for high income earners, 75,000 single, 150,000 married filing joint. You won't be able to use this higher deduction, but I think that's what they're trying to offer to seniors as an offset because they're not able to say no tax on Social Security. Now, maybe we'll see some other amendments coming to the bill on the House floor or in the Senate, who knows, but right now there is no provision saying no tax on Social Security Security, but there is an additional higher standard deduction specifically allowed only for seniors of $4,000. Now, the next big provision is state local tax deduction for individuals. This is a deduction you get to take on your federal return to say, hey, I paid $20,000 of state and local tax to my state. I want a deduction for that on my federal tax return. So let's say, for example, you made 200 grand a year and you had to pay $20,000 to your state. You want to go to the federal government and say, hey, don't tax me on that 20 grand. I didn't get to keep it. I had to send it to the state. Only tax me as if I made 180K. Now, what is in place right now in the current law is a limitation of a $10,000 deduction only. You can only deduct up to $10,000 of state and local tax. Now, this was something that was enacted in the last tax reform that is set to expire at the end of this year. Now, what happens when it expires at the end of this year is there is no cap. The cap was a new thing that came on of $10,000 as a way to raise revenue in last tax reform because they had so many cuts. They needed to think of some ways to raise revenue. So they put on this $10,000 cap. Now, a lot of Republicans in high tax states want the cap removed entirely. They're like, that's not fair. If I made 200 grand and I had to pay $20,000 to the state, I can't pay tax on 200 grand of income to the federal government. I didn't get to make 200 grand. I only got 180. The state took the other 20 grand. How am I supposed to pay tax to you on that? I never even had that income. Fair argument, but right now we have the cap of $10,000. Now, this is a contentious political issue. This is one of the number one things that might derail this bill, particularly in the House right now, because you have House Republicans from high income tax states that don't like this. They want the cap removed entirely. They're like, our constituents get crushed on this because they have to pay a large state income tax and they get no deduction and they're being taxed by the federal government on income they never even got to keep. On the other hand, you have House Republicans in no income tax states that don't give a crap about this and are like, we don't care, tell your people to move to our state. So it's a tricky political issue, and because Republicans have a thin margin in the House, this could be causing problems. Now, what's in the bill here is an increased cap of $30,000. So they went up from 10 to 30, meaning you're going to get a much larger deduction for those paying state and local income tax. Again, this is off your federal tax return. However, they put in a high income phase out for individuals making $200,000 single or $400,000 married. Frankly, those are the people paying more than $30,000 a year, and said, you don't get to use this. It phases out anyways. So this provision and this cap is already causing issues in the House. We'll see in the next couple weeks how this goes, what negotiations are worked out, or if any of these moderate Republicans from states like New Jersey, New York, California band together and hold out on the bill entirely. They have threatened that, and they have enough votes that they could kill the entire bill. We'll see how this one goes. It's very politically charged, even within the Republican Party. All right, now the last one on the individual side is there is a new limitation in the bill that is going to limit the value of an itemized deduction to 35 cents on the dollar. Now, if you think about this, the new maximum rate is 37%. So you should expect to get 37 cents on the dollar when you get a deduction. So what this is effectively doing is for the highest income earners, those in the highest bracket, it is minimizing the value of the deduction they get to take. So that is something punitive for higher income earners. Again, those that are at 35% rate or lower, they still get the full value of their deduction, so it doesn't affect them. So this is something that is hitting the higher income earners harder and is limiting the value of the deduction. Now, one other thing that we did not see in the bill was the higher 39.6% rate Trump mentioned he'd be willing to do for those making $2.5 million or more. That is not in the bill. That may be something negotiated that comes back. We'll have to wait and see on that. But good news, the highest rate is 37% period. There is no additional new bracket for those making $2.5 million or more of 39.6%. All right, now last but not least, we've talked about taxes as you're living and making money, but what about when you die? The estate tax has an exemption. So in the federal tax code, we have an estate tax that says, hey, when you pass away, you pay almost 50% of your estate to the federal government. However, you get an exemption up to a certain estate amount. Right now, that exemption is around $15 million, but it is set to go down to a $5 million exemption next year. Under this bill, it is being made permanently at $15 million per individual. A married couple can double up on that if they plan right to get a $30 million estate tax exemption. What that means is, unless you have an estate larger than $15 million, you will not have to pay estate tax. That can pass on to your family. Anything over $15 million, though, the ultra wealthy, half of their estate is going to go to the federal government under the estate tax. So that's going to be made permanent in the bill, which which is nice because a lot of the provisions on estate tax have been jumping around to no exemption, to a $15 million exemption, to a $5 million exemption. As people are planning their estates and charitable giving and what's going to go on to their family, it's caused a lot of havoc for small business owners, people with the family farm that have a significant estate but want to make sure they don't lose it to the federal government or have to sell these types of assets. So it's nice that it's being not made unlimited, but at $15 million, and it is being made permanent. So it's something you can better plan around in the future. Now, so much of this is in flux. We're going to have to see what the full House does, what the Senate does. Again, the deadline that the Republicans have put on this is the 4th of July. They want to have this on the president's desk to sign and put into law. Trump is calling this his big, beautiful bill, and he's definitely behind it and trying to get this pushed through Congress using his political will to get this done. This is going to be good for the economy. In my opinion, I don't want to be political here, but generally tax cuts are good for the economy, and a lot of these cuts are targeted at middle income earners. There's a lot of wins for everyone across the board. This is not something that's just for the rich. So I think there's a lot of benefits in this bill. Small business, individuals, no matter where you're at in the income tax rate scheme, you're going to get a lower tax rate and you're going to be paying less tax, putting more money back out in the economy. Now, knowing where tax policy is going is critical, but having a great tax strategy and plan, no matter what's going on, is what we do at my law firm, KQS Lawyers, every day. Get over to KQS Lawyers and book a call with our team. We do a comprehensive tax and business plan for each of our clients where we go into the strategies they can use to pay less tax, protect their assets, and grow and build wealth. And that's what I'm doing on my channel too. I'm educating you on that every day here, so please make sure you're subscribed. And I'll be back with more updates on this bill as it goes through, let you know of any amendments or new things coming in the bill. And of course, I'll be letting you know when it's signed into law. I'm Matt Sorensen. We'll see you next time.